Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the theory for Chapter 7, which is cash and receivables. This is video number 3, right? And in this video, we are going to cover the allowance method, right? And in the previous video, we had talked about the direct write-off method for our uncollectible accounts, our bad debt accounts. And we had used the accounts, we had our accounts receivable, we had our bad debt expense account, and we also had our cash account. And without going into a lot of detail, as you'll recall, if we had like a $300 accounts receivable, when we made the journal entry, we would debit our bad debt expense account for the $300, and we would credit the accounts receivable for the $300. Okay, so when we posted it to the general ledger accounts, okay, now our accounts receivable would be 0 for that particular customer, and that would move it over to the bad debt expense. And so we would expense it, would be off of our books. And then if later, for some reason, the customer decided to pay, well, then what we would do is we would reverse this entry, okay, and that would put the $300, that would put the $300 back on our books, and it would take it out of the bad debt expense, and then to pay off the $300, all right, for our accounts receivable, we would credit the accounts receivable for $300 and then debit the cash for $300, so it would show payment. So in effect, our bad debt would be 0, our accounts receivable would be 0, and we'd be back with the original entry, which was a debit to our cash here and a credit to our sales revenue. So everything kind of like would wash itself out. Now, when we're using that works good if we only have a limited number of clients that we can keep track of, whether that's 50, 100, 150. But when you have thousands of clients, like credit card, a bank or a credit card company, and has thousands, it's just impossible to be keeping track of each and every individual, customer that you have. So that's where the allowance method comes in. Now, the allowance method will use the accounts receivable account also. It'll use the bad debt expense account, but instead of just using those two as the direct write-off method, instead it will we add another account, another ledger account, which is allowance, and I call it for doubtful accounts, or it could be allowance for uncollectible accounts. Uncollectible, or you could use the word doubtful, right? That's interchangeable, right? I have a tendency to use allowance for doubtful accounts because that's what I learned on. I notice in the book it says allowance for uncollectible accounts. Both are mean the same exact thing. So you'd have a general ledger account called allowance for doubtful accounts, and this would be in the asset section and would be listed right after the accounts receivable, because what you would have is you'd have your cash, then your accounts receivable, and your allowance for doubtful accounts. And then these two, right, would have balances, and then what you would have is you'd have a net accounts receivable, all right? So that would be the net of those two accounts. Even though your accounts receivable might be 30,000, and if you had an allowance of say 5,000, your net receivable is actually 25,000. Okay, so that's how it would be shown on your balance sheet. All right. So the allowance for doubtful account is an asset account. All right, and then of course you would also have a cash account if they decide to pay off. So what ends up happening is allowance for doubtful. Okay, so the way this kind of works is, in order to use the allowance method, and in order to determine your uncollectible accounts, there's actually two methods, two calculations, two ways of calculating. There's the percent of sales method, and there is also the aging method. Okay. These are two different methods that will help determine the dollar figure that you're actually going to write off as your bad debt. Okay, bad debt, B-A-D, not D-A-D. You use those two methods to determine, however much you're going to write off for bad debt. Now, I'm not going to cover these two methods in this video. I will have one video specifically for the percent of sales method and a following video for the aging method. Okay, just realize that these two methods will be used in order to determine this dollar figure, which is what we're going to use as part of the allowance method. So I'm kind of like covering what the allowance method is, but I'm not going to get into great detail in the calculations because that's for the next two videos. So let's say our accounts receivable here is $16,000, okay? And we determine that we're, depending upon those two methods, whichever one we're using, let's say we determine that we're going to write off $2,000 to bad debt. Now, if we were using the direct method, okay, we would know exactly which customers they are, okay, and we would then credit our accounts receivable and debit our bad debt. But when you have tens of thousands of customers, that's it's highly unlikely that you're going to be going through each and every account, okay? So instead what you do is you say, okay, what we're going to do is we're going to create this allowance for doubtful account. And in the allowance for doubtful account, we're going to say, okay, we determined that we're going to write off $2,000, so we're going to debit our bad debt expense, and this is the adjusting journal entry that you're going to make at the end of the accounting period, and you're going to credit your allowance for doubtful account or uncollectible account in the amount of $2,000. Okay, so when you post that to your general ledger accounts, you end up with the $2,000 under your bad debt expense, okay, and you end up with the $2,000 as a credit under your allowance for doubtful account. So remember, on your balance sheet, you're going to have your cash, your accounts receivable, and then you're going to have your allowance account, right? So your accounts receivable will show the $16,000 less the allowance, this is less the allowance for doubtful account of $2,000. So your net accounts receivable is going to be $14,000, and that's how you know what your accounts receivable is. Sure, your accounts receivable says there's $16,000 in it, okay, but you're guesstimating that you're going to write off $2,000 and that your accounts receivable is only the actual $14,000. Now, as time goes on, you're going to actually have to, you can't just let the accounts receivable build and build and build and build and build, okay? You actually have to go and say, okay, I think this account is bad, that account is bad, whatever, okay? And you have to take them off your accounts receivable. So when you do that, you're going, and I'm just going to use $1,000 here for one customer. So I'm going to credit my accounts receivable for the $1,000, and I'm going to debit the allowance for doubtful account for the $1,000. Okay, so when I actually, when I make this first entry here, all I'm doing is guesstimating. Okay, but when I go and I say, I know that John Doe here is not going to pay, right, his $1,000, then I make this entry and I back it off against the the allowance for doubtful account, because I've already written it off against the bad debt. So I would have a credit for $1,000 here, and I have a debit of $1,000 here. So now my allowance for doubtful account, only has a balance of $1,000 in it. and my accounts receivable has a balance of $15,000 in it. But notice the difference between the two is still the $14,000, like I had shown on the balance sheet there. Okay, so it's a two-step process here, in that at the end of every accounting period, depending upon which method you're going to use, whether it's the percent of sales method or the aging method, which you'll see how they work in the next two videos, you'll determine what amount you want to write off as an estimate of what's going to be your bad debt for accounts receivable. And you're going to make this journal entry. When you make this journal entry, you're booking the bad debt expense of $2,000, and you're putting it as an estimate in your allowance for doubtful account. So you're actually booking the $2,000, and you have this here contra account to the accounts receivable. Now, as you go through and you determine which accounts receivable accounts are bad, then you make this second entry, which actually takes it out of your accounts receivable and is making your accounts receivable more accurate. But since you've already written it off to the bad debt expense when you made the first entry as an adjusting entry, you can't put it against bad debt. You put it against the allowance for doubtful account, and it keeps that estimate more in line. All right. Now, I'm going to have to kind of like warn you here, in that this allowance for doubtful account is always going to have a running balance in it, and depending upon the method you use, which you'll see, whether it's the percent of sales method or the aging method, if you're using the percentage of sales method, basically and I don't want to get into too much detail here, but I'm just going to give you a heads up. Using the percent of sales method, you're kind of like saying, okay, I know from history that this is the percentage that is of my sales that is going to be bad debt, and you allow that. You're always adjusting to whatever you have for sales. You're saying that's what I'm going to write off. But if you're using the aging method, what you're going to do is you're always going to have a running balance, and you're going to constantly be adjusting to the new amount that you think should be in your allowance for doubtful account. And like I said, you'll get this in the next two videos, but I just want to give you a heads up that depending upon the method will determine how much you're actually going to have in this allowance for doubtful account. What you don't want to have happen is you don't want your accounts receivable to keep on increasing and increasing and increasing because you have bad estimates. Okay, and that'll be covered in those next two videos. Okay, because you don't really know. I mean, you take on an accounts receivable, you're giving them credit, but you can't, theoretically you're saying you're going to pay me, all right, so I should have no bad debt, but you don't know what's going to be a bad debt. And if you don't know what's going to be a bad debt, and some of it is bad, then your accounts receivable is just going to keep on inflating, and you're going to have an inaccurate accounts receivable. And so depending upon how you handle the allowance for doubtful account, will be able to keep your accounts receivable more in line with what it should be. If it's the direct write-off method and you're keeping these accounts on your books, even though they're 5 years old and they've never paid, and they have to be written off. Okay, and so you just write them directly off because you're never going to collect them. And using the direct write-off method, it's very easy to be more accurate. The only thing that you have to determine is as to when when you're going to finally say, that's it, I'm not collecting this debt. But when you're talking about tens of thousands of customers, you can't be going through each and every individual account, and always constantly which one. So in using the allowance method, it's more of a mechanical kind of thing where I say I'm going to use the percentage method or I'm going to use the aging method, and these are the numbers I'm going to stand by, and you're always adjusting to whatever you determine is going to be that bad debt. Okay, so I hope you understood that. Now let me just real quick here. What happens if somebody does decide to pay, you know, let me just, what if, you know, John Doe here, okay, you know, we wrote off his $1,000. You know, we said, okay, you know, we know he's never going to pay us that $1,000, so we wrote it off here. You know, and let's just say that's in January. Okay. Well, what happens when it, say, becomes September and he comes back and says, hey, look it, you know, I need your product or whatever it is. You know, I'm willing to pay off my bad debt in order to be able to continue to do business with you. And you say, fine. So what ends up happening is you have to reverse, okay, your account. You have to reverse this entry, all right? You have to put it back on the books. All right, so you're going to have an entry where you're going to add 1,000 to the accounts receivable, and you're going to add the 1,000 back to the allowance for doubtful accounts. Okay, I'm sorry, that's a debit there. No, I'm sorry. Yeah, that's a credit there. So now your, you know, your accounts receivable, all right, is back up to, you know, the figure that, you know, you've got it back on the books, and then when he pays the cash of the $1,000, okay, then you write it off against the accounts receivable, and your books are back to where they need to be. Okay, you'd still have the $2,000 in allowance for doubtful accounts, and of course that is going to be adjusted each and every time at the end of each and every accounting period. So I know the screen is getting a little messy, but this is it needs to come to this point. So let me do this. Let me get everything sort of back to where I need it to be. And maybe I'm just going to go and just do it like this. And then I have my cash account over here. Okay, so let's say my accounts receivable is $16,000. Okay, and I determine that I'm going to write off $2,000. So I write off the $2,000, and I make that journal entry, adjusting journal entry at the end of January. Okay, and now let's say at the end of February, my accounts receivable has gone up to, say, 20,000. Okay, so the 16,000 is no longer on the books. My accounts receivable show 20,000. All right, my allowance for doubtful accounts still has this $2,000 in it, right? But now, based upon whichever method I'm using, you know, maybe this, you know, 20,000 isn't accurate. Maybe I need to write off 1,000 additional more. Okay, when I do that, okay, I would have to make at the end of February, I'd have remember this here 2,000 in January, because it's an expense account, would be closed out. So at the end of January, right, my bad debt expense is going to have a zero balance in it, right, because that $2,000 will already be written off. My accounts receivable will still be $20,000 at the end of February, and my allowance for doubtful account will still be $2,000 at the end of February, because those are asset accounts, right? This bad debt expense is an expense account. So when I look at when it comes time for me to look at my books at the close of business in February, maybe I've determined that out of this $20,000, my bad debt expense is supposed to be, my allowance for doubtful account is supposed to be $2,500. Well, now what I need to do is I have to make an adjusting entry for an additional $500. You know, I determined $2,500 is bad, but I want to end up with a balance of $2,500. Well, to get to that balance, how much do I have to write off? Oh, I have to write off $500 more. So now my $500 would go into my bad debt, and I'd have an accurate accounts receivable there of 20,000 less the 2,500, or my net accounts receivable should be 17,500. Okay, it is 20,000 at the end of February. I determined that I need to write off, you know, that 2,500 of it is bad debt. Remember, we're using the percentage method or the aging method to determine that. And because of that, I need to say, okay, I need the balance in my allowance for doubtful account to be $2,500. Well, if I had $2,000 in it before and I need it to be $2,500 now, how much do I have to write off? Oh, I have to write off $500. And so then I make that journal entry, the adjusting journal entry to debit my bad debt expense for $500, and I'd make that a credit to my allowance for doubtful account for $500. Okay, right. So at the end of each accounting period, when I come over here to March, okay, I'm going to basically do the same thing again. I'm going to look and I'm going to say, okay, how much is my accounts receivable? Well, if my accounts receivable at the end of March is, say, 18,000, okay, at that time, and I determine that 1,500 is going to be bad debt. I mean, yeah, it is going to be bad debt, meaning I want to have a net realizable value of 16,500. Okay. Well, if I have $2,500 in my allowance for doubtful account and it's only supposed to be 1,500, right? I want to have that balance being 1,500. That means now instead of having a credit to allowance for doubtful account, I'm going to have a debit for $1,000. Okay, so by having the debit to allowance for doubtful account of 1,000, I would end up crediting my bad debt expense for 1,000. Okay, so in March, my bad debt expense would have a credit of 1,000, even though it's an expense account. Okay, so what you're doing is you're always keeping this here running balance. Now, I'm making it very simplistic here. I'm not showing that, I've written off, specific customers and so on and so forth. What I'm trying to do is I'm trying to get you to realize that um, you're you're going to look at your accounts receivable and you're going to see the balance. Depending upon the method you use will determine how much you're going to write off. What you decide to write off, that should be the balance in your allowance for doubtful account. When you look at the balance in your allowance for doubtful account, you have to figure out how much you're going to adjust that account for in order to make it match that balance. And when you figure out what that amount should be, whether it was $500 or whether it's $1,000, you're going to make the journal entry to the allowance for doubtful account and the bad debt expense account in order to make sure that your allowance is correct, so that your net realizable value of your accounts receivable is correct. Okay, and that's kind of like how it works. Hopefully that made sense. When you read the book, what happens is a lot of students they'll follow along in the book and they'll realize, okay, yeah, I have to make this journal entry. Okay, and that works fine when you're thinking about it from a 1 month perspective, when you're looking at just this particular month. Okay, whether and they seem to understand that. But where a lot of people go wrong then is well, what do you do in the next month? And they don't realize that the whole idea, intent, and purpose is that um, you have your accounts receivable, and you want to know what your net accounts receivable is. And well, your net accounts receivable is what you have as receivables, but how much you're going to actually write off, right? Which is what we're going to use for our allowance for doubtful account, right? So that gives us accounts receivable less your allowance gives you your net accounts receivable. And so this is the number that we're saying is accurate for our accounts receivable, but that means we're making an estimate here, all right? And so for each and every month, in order to, we know exactly how much that accounts receivable is, all right, because it's on our books. We know which customers owe us what, but we don't know what we're actually going to write off. So we kind of make a guesstimate and say, okay, I think the true value of my accounts receivable is this net amount. Well, in order to get to that net amount, I have to say, okay, this is what my allowance for doubtful account should be. And whatever amount that should be, I have to adjust this account to get that correct amount. Right here, I have $2,000. Let's say that this is supposed to be $3,500. Well, if I already have $2,000 in there, that means I have to make an adjusting entry of $1,500 in order to get it to $3,500. That's what I'm constantly always doing, and I'm using that journal entry that you see in the book, using the two accounts, the allowance and the bad debt expense account. You know, you're always, I can't tell you it's definitely going to always be a debit to bad debt and a credit to allowance, because it isn't always going to be that way. In the book, if you're reading it, it may lead you to believe that that's what you're actually always going to have, because it's only looking at one accounting period, trying to give you the idea, trying to get across the concept to you. But the reality is that if I had an allowance of 3,500 here, and then for whatever reason I determine that my allowance for doubtful account is only supposed to be 1,000, right? Well, then I'm going to actually have to make a journal entry that has let's see, 1,000, so that a $2,500 debit to allowance. And if I have a debit to the allowance, remember this is a debit, I have to credit something else. Well, then I'm going to have to credit my bad debt expense for $2,500 in order to have the balance. Oops, wrong side. In order to be able to have the balance in my allowance for doubtful account to be $1,000. All right. Okay, so I've kind of said the same thing now 3 different times in this video. All right. Um, this is the theory behind it, and it is a little confusing until you get accustomed to working with it. So that's where the exercises are going to come into play. So make sure that you do the homework problems, because you will have you'll have to work through these numbers on an ongoing basis, okay? And you'll be able to see what I mean by making sure that the running balance and the allowance for doubtful account is correct, okay? Because remember, it's the accounts receivable less your allowance, which gives us our net accounts receivable, which is the value we think that should be on our balance sheet. And in order to do that, you always have to keep track of this running balance of the allowance for doubtful account, because your books are going to show the customers and how much they owe, but you're going to always have to be updating this account to be guesstimating what gets written off. All right, so with that said, I'm going to stop here. If you have any additional questions, I know it's a complicated subject, and I tried to present it as easy as I possibly could. But in the next video, I'm actually going to go and try to give an overview. It'll be a relatively quick video, but I'll try to give an overview as the differences between the direct write-off method and the allowance method. And then in the following 2 videos, I'll discuss the percent of sales method and the aging method to determine how much you're going to need for the allowance for doubtful accounts. So in those videos, I'll see you then.